I used to think money was the scoreboard. The bigger the number, the better you were. Growing up in Queens, I didn't want an ordinary life. I wanted money, freedom, and the kind of success that made ordinary rules feel optional. My first lessons in selling came long before Wall Street. As a teenager, I sold frozen treats and discovered something important. People weren't just buying the product. They were buying the way I presented it. Later, I tried selling meat door to door. The business actually worked for a while. But revenue wasn't profit. Spoiled inventory, transportation, unpaid invoices and cash flow problems eventually destroyed it. Still, I learned one skill that stayed with me. I could sell. I could knock on a stranger's door, handle objections, create urgency, and close a deal. That skill eventually brought me to Wall Street. My first brokerage job was at L.F. Rothschild. I wasn't a trader. I was a salesman. And I quickly learned that Wall Street wasn't simply about predicting stocks. It was about commissions, order flow, client relationships and persuasion. Then came October 1987. Black Monday destroyed the market and my job with it. While others saw disaster, I started looking for another entry point. That's when I discovered penny stocks. These securities traded outside the major exchanges, often with thin liquidity and limited public information. For brokers, the commissions could be enormous. The business model was simple. Find a stock with a good story. Call investors. Create excitement. Convince them they were getting in before everyone else. I learned the language quickly. Ground floor. Undervalued. Limited opportunity. Before Wall Street discovers it. The numbers mattered, but the story mattered more. A customer didn't need to understand the balance sheet if I could convince him that missing the opportunity would be worse than taking the risk. That was when selling became my real profession. In the late 1980s, I built Stratton Oakmont. The company looked respectable from the outside. Inside, it was a high-pressure sales machine. We hired young people who were hungry and aggressive. Many had little financial experience. I didn't need analysts. I needed closers. We trained them to control conversations, overcome objections and move customers toward a decision. The office became incredibly competitive. Phones rang all day. Managers tracked sales. Top brokers received enormous commissions. People who couldn't produce were replaced. The system rewarded one thing above everything else. Closing the deal. Then the money started pouring in. But we discovered something more profitable than simply selling penny stocks. We could participate in stock offerings, create demand, and profit from rising prices. The basic manipulation was straightforward. Cheap shares were acquired. The sales force aggressively promoted them. Investors bought, the price rose, insiders sold. Then the demand disappeared. The people who bought near the top were left with collapsing shares. It was the classic pump and dump model. Inside the company, however, the pressure to keep the machine running made everything seem normal. Success became its own justification. The bigger we became, the harder it was to admit what was happening. By the early 1990s, Stratton Oakmont had become a financial circus. The office was filled with expensive cars, designer clothes, drugs, parties and enormous egos. I bought mansions that I bought luxury cars that I bought a yacht. And I started believing that money meant I had one. That was the trap. Luxury stopped feeling luxurious. It became normal. Then normal became insufficient. The business was growing, but so were the risks. Regulators began noticing suspicious activity. Investors complained about stocks that collapsed after they bought them. Questions were raised about companies with little revenue, weak operations, or exaggerated prospects. But inside the firm, the response was simple. Sell harder. The more money we made, the easier it became to ignore the warning signs. My personal life was deteriorating too. Drug use became routine. I was taking increasingly dangerous risks. My marriage was falling apart. I was making decisions while intoxicated that could have killed people. At one point, I ignored warnings during a storm while sailing in Europe. The yacht got into serious trouble and had to be rescued. I survived. But I still hadn't learned the lesson. I believed consequences were things that happened to other people. Then the investigators arrived. The government began connecting bank records, trading activity, corporate filings, phone calls and money transfers. Former employees started cooperating. Some recorded conversations. Others handed over documents. The business I had built was beginning to collapse from the inside. In 1996, federal agents raided Stratton Oakmont. They weren't interested in the expensive furniture or the cars. They wanted records. Trading information. Phone records, computer files, financial documents. The paper trail mattered more than the image. I was still desperate to protect my money. Even while under investigation, I continued moving funds. One major transfer to Switzerland became especially damaging. By then, the government had enough evidence. I was facing decades in federal prison. So I made the decision that would determine the rest of my sentence. I cooperated. I wore a wire. I provided information. I helped prosecutors build cases against people who had once worked for me. There was nothing heroic about it. I wanted a reduced sentence. Eventually, I received 22 months in federal prison. But prison wasn't the only consequence. The greater damage was financial. People had trusted me with their savings. Some lost retirement money. Some lost years of financial security. Some borrowed against their homes. Those investors didn't get book deals. They didn't become movie characters. They simply lost money. While serving time, I began writing about my life. That eventually became The Wolf of Wall Street. The story was outrageous: money, drugs, yachts, parties, fraud and excess. Then Hollywood came calling. Martin Scorsese directed the film. Leonardo DiCaprio played me. Suddenly, the convicted financial criminal had become a pop culture character. People laughed at the chaos. They admired the confidence. They quoted the speeches. The story of financial fraud had become entertainment. And that's where things become uncomfortable. A movie can make greed look exciting. A luxury car can look like freedom. A yacht can look like success. A giant office can look like proof that the business is legitimate. But the camera doesn't always stay on the other side of the transaction. The retiree who lost savings. The family that believed the pitch. The investor who bought near the top. Those people don't usually become part of the legend. The government eventually ordered substantial restitution. But financial damage doesn't disappear simply because a criminal sentence ends. That's one thing people often misunderstand about white-collar crime. There may be no broken window. No robbery at gunpoint. No obvious victim standing in front of you. Instead, someone opens a brokerage statement and discovers that years of savings are gone. The damage can be almost invisible. After prison, I rebuilt my career as a speaker, author, and sales trainer. That created an uncomfortable question. How does a convicted fraudster become a motivational speaker? The answer is that people love transformation stories. They like watching someone fall, survive and return with a new message. But redemption and reinvention aren't necessarily the same thing. My story taught me that ambition itself isn't dangerous. The danger comes when ambition becomes an excuse. When making money becomes more important than how you make it. When confidence replaces evidence. When an entire organization rewards people for ignoring ethical boundaries. And when everyone around you is getting richer, even obvious warning signs can start looking like opportunities. I once believed money was proof that I was smart. I was wrong. A large bank account doesn't prove your decisions are good. A luxury car doesn't prove your business is legitimate. A crowded office doesn't prove your customers are being treated fairly. And a convincing stock pitch doesn't prove the investment is worth buying. Financial markets ultimately come back to numbers. Eventually, someone asks where the revenue came from. Who owns the shares? What is the company actually worth? Who benefits when the price rises? And who is left holding the loss? You can delay those questions. You can bury them beneath confidence, paperwork, expensive suits, and impressive offices. But you can't eliminate them. Eventually, reality comes due. I spent years believing the smartest person in the room was the one who could convince everyone else to believe his story. Now I understand something very different. The real test isn't whether you can sell people a dream. It's whether what you built can survive when someone checks the numbers. Because sooner or later, somebody will. And when that happens, no sales pitch can protect you. Not the money, not the reputation, not the yacht, not the movie. And certainly not the myth. Because the most expensive lesson I ever learned wasn't how to make millions. It was learning that money earned without limits can eventually cost you far more than money could ever buy. There was another lesson I didn't understand until much later. Financial markets run on trust. Every trade depends on the assumption that the information being presented is reasonably accurate, that the counterparty is operating within the rules, and that prices aren't being secretly manufactured for someone else's benefit. Break that trust, and the damage spreads far beyond one transaction. A legitimate company can spend years building a reputation. An investor can spend decades building a retirement account. A broker can spend years building a client relationship. All of that can disappear after a few dishonest decisions. That's why the real currency in finance isn't money. It's credibility. Once credibility is gone, everything becomes more expensive. Borrowing becomes harder. Investors demand more proof. Partners become cautious. Regulators look closer. And eventually, every new opportunity starts with the same question. Can I trust you? I used to think persuasion was about getting someone to say yes. Now I understand that good financial persuasion should also make room for someone to say no. That distinction matters. A salesperson who needs every customer to buy isn't really giving advice. He's chasing a commission. A broker who hides risk isn't creating opportunity. He's transferring risk to someone who doesn't understand it. And a company that needs constant hype to support its stock price isn't creating value. It's borrowing confidence from the future. Eventually, that debt comes due. I learned that lesson after millions of dollars had already moved through my hands. I learned it after employees had built careers around the system. I learned it after investors had trusted us. And I learned it after the government had already started putting the pieces together. If I could go back, I wouldn't tell myself to stop being ambitious. I'd tell myself to understand the difference between selling and deceiving. Selling means presenting an opportunity and allowing someone to make an informed decision. Deception means controlling the information so the other person can't make that decision honestly. The difference can be one sentence. One missing fact. One exaggerated projection. One hidden conflict of interest. One promise you can't guarantee. That's how financial crimes often begin. Not with someone announcing, "I'm going to become a criminal." They begin with a small compromise. Then another. And eventually the person who once thought he was bending the rules discovers that the rules have become something he barely recognizes. I spent years chasing the feeling of being untouchable. In the end, the money didn't make me untouchable. It only made the consequences larger. That is the part of my story that never looks good on a movie screen. There is no dramatic soundtrack for an investor opening a statement. No glamorous montage for a family cutting expenses because their savings disappeared. No applause when someone spends years trying to recover money they believed was safely invested. Those are the quiet consequences. And quiet consequences can last much longer than headlines. The world remembers the yacht. The parties. The expensive cars. The movie. But the financial industry remembers something else. Trust is fragile. Markets work because millions of people agree to believe that the numbers mean something. Once enough people learn that the numbers can be manipulated, confidence disappears. And without confidence, even a sophisticated financial system can become remarkably fragile. That's why my story isn't really about how to get rich. It's about how quickly wealth can become an illusion when the foundation underneath it is rotten. I spent years building an empire around that illusion. Eventually, I had to live with what happened when everyone stopped believing it. The lesson was brutally simple. You can manipulate a price. You can manipulate a customer. You can manipulate a story. But you cannot permanently manipulate reality. Eventually, the numbers speak. And when they do, they don't care who you are.